Hey everyone, I wanted to talk a little bit more about CPP investments, and this is probably the last video I'm going to make about it. I'm not here to be a crusader against CPP-IB, I really just wanted to open a public conversation on the topic because I think it's something we've mostly ignored for a long time and it deserves more oversight. But there's also a lot of other things I want to talk about on this channel, and despite the amount of work I put into that video, I kind of don't want to talk about it anymore for reasons that will hopefully make sense by the end of this video. I'll warn you up front that the first part of this video is going to be kind of boring, but it'll provide context for the, let's say, more interesting stuff I'm going to talk about towards the end. So after I published my video on CPP investments, their active management strategy, and what we're paying for it, I got a lot of responses from a variety of people, including some people in the investment management industry. And I knew when I published it that the industry people would take issue with some of the things I said because there are areas of the video where there's oversimplifications or things that are imperfect comparisons, which is true. There's reasons for that, like making the video comprehensible to non-experts and for the sake of not making the video 9 hours long. But beyond that, everything that's in the video is included for its own specific reason, which might not always be obvious. One of the best conversations I had about this was with Ben Felix, who's a portfolio manager that has a podcast called Rational Reminder, which I actually referenced at one point in the video. And the great thing about Ben is that he's very intelligent, he's very reasonable, and he's an all-around likable guy who makes very good points that have knowledge and nuance behind them. One of the things he brought up was that Norway's sovereign wealth fund isn't a good comparison because they're not a pension fund and their liabilities are completely different and not as rigidly structured as ours are. They basically just pay a bit of money out to the government when they run a budget deficit, and the government puts money in when they run a surplus. CPP, on the other hand, has pretty serious requirements for how much they have to pay people and when. And that's absolutely true. The reason I included Norway in the discussion is because there's a popular perception among ordinary people that if you have a very large amount of money to manage, you must also need a very large and complicated strategy to manage it, or something bad might happen to it. But Norway manages a much larger fund with a lot fewer people at a much lower cost, even though they also include some active management elements, and they're doing fine. But yes, it's not a pension fund, so we wouldn't do exactly what they do. Another thing he brought up was that when I was talking about the Nevada pension plan, I spent a lot of time talking about volatility and how it's not an existential risk to the fund. But volatility isn't the only risk or even the main risk. There's things like inflation risk in terms of pension liabilities, which is a bigger concern because while market downturns tend to be followed by rebounds, inflation generally doesn't reverse itself, so it's more of a permanent impact on the fund. This is also correct. But I spent a lot of time on volatility because it's one of the big concerns I see people have with the concept of passive management. I've seen dozens of comments from people in the past saying, well, what if the portfolio drops 20% in a year like in 2008? Then we won't be able to pay out benefits and the fund will collapse. But it's really not as big of a deal as people think given the size of our fund relative to the size of the net payouts, and in fact, the actual strategy they're using does involve that level of market risk, which I think is fine. I don't think they're using an overly risky strategy. But yes, there are other important concerns, like inflation, which CPP is actually more exposed to than Nevada because Nevada uses a predetermined annual adjustment for benefits, while CPP uses actual inflation. The reason I included those things in the video is the same reason that I started off the video by saying that CPP is not running out of money, you can be confident that you get CPP when you retire, and that the current strategy they're using right now doesn't actually endanger any of that. What I'm trying to do is remove fear from the discussion. People have a lot of fear around money, particularly when it comes to things like pensions, because they're worried about themselves or their loved ones being put in a position where they don't have enough money to make ends meet, especially in old age. And I'm out here competing against a bunch of voices saying stuff like CPP is a scam, CPP is going to go broke, the government is stealing from CPP, or we should get rid of the CPP and let people invest their money themselves. But look, I think it's important that we have the CPP and an investment board to manage the fund. I think it's important to keep the CPP going, and I even think it's important that I can't opt out. If I was given my CPP premiums back to invest myself, I could probably come out ahead of what I'd have with a CPP by the time I'm 65. Part of that is because I have enough knowledge to invest in a high yield strategy that will work for an individual but wouldn't work for a pension plan. But another part of that is that I'm in the privileged position of having enough money to comfortably cover all of my expenses, so if I had extra money, I could invest it. I'm not really that worried about people who would put all their money into Fartcoin and lose everything, or people who would waste it partying. What I'm worried about are people who would feel extremely pressured to spend that extra money immediately because they're already struggling, which, as inequality keeps rising, is getting to be more and more people these days. They'd be a little bit better off in the short term, but they would eventually arrive at retirement with nothing at all. That's why I say that CPP is an important financial backstop for our whole society. So I want to remove fear from the discussion because I want people to feel like they can ask questions or have a discussion about our pension plan without having fear that they will lose it. Now, going back to what Ben said, he made a good point about needing to hedge against inflation and said that some people would argue that the best ways to do that are through things like private credit or private infrastructure, which you need some amount of active management to acquire. I'm not opposed to that. I think it's totally reasonable to include that sort of stuff in the portfolio as long as it has some foundational basis that's linked to a requirement of the fund. We can have it, and it should be big enough to address the related concern, but not necessarily any bigger than that. Like I said at the end of the video, we don't need to tear the whole system down, but we should actually examine what we're doing and whether or not we think it's justified. He also said that focusing only on the reference portfolio's asset value performance isn't necessarily the best metric, even though that's what CPP Investments said in their reports, and that measuring something like the relative liability performance might be more relevant. And despite how much I railed on the reference portfolio in the video, he's also got a point here. The primary purpose of a pension fund isn't to make as much money as possible, it's to provide reliable payouts of its long-term liabilities to pensioners. If we actually end up doing some kind of reform, which I think we probably won't, I don't think it's as simple as just buy the index and chill. But figuring out what a more efficient fund looks like is best left to smart people like Ben Felix, not morons like me. But here's the thing about making the reference portfolio their performance benchmark and saying their goal was to get higher returns. In giving themselves a mandate to pursue higher returns, they also, in a sense, gave themselves permission to pursue any kind of investment strategy in as many different ways as they want and grow the organization as much and as quickly as they wanted, as long as it didn't wreck the pension fund. If their goal is to pursue higher returns, the strategies don't all need to be related to liability hedging. They can kind of be whatever they want if they think it'll make more money. I did a lot of research for that video over the past 9 months, and there's more information that I left out of the video than I left in. But there are some investments that have been made on our behalf that I, as a Canadian citizen, someone who pays into CPP, and someone who will eventually collect benefits from CPP, assuming the fund managers don't find out who I am, find questionable. I'll give you an example. At the end of 2013, CPP Investments acquired a 15% stake in a French company called Orpea, which is a provider of private, for-profit, long-term care facilities for elderly residents in locations around the world, but primarily in Europe. In France, they promoted themselves as a high-quality operator with luxury-style facilities and accordingly charged higher fees for care, up to 6 times the national average. CPP Investments appointed one of their employees to sit on the board of directors of Orpea. Later, in 2016, they were able to appoint a second member to the board of directors. In January of 2022, a French investigative journalist named Victor Castanet published a book titled Les Fossoyeurs, which translates to The Gravediggers. This book was the culmination of a 3-year investigation into the quality of care and financial irregularities at Orpea. While this is still being officially investigated today, the allegations in the book include a system where facility managers were heavily incentivized to maximize profits, leading to numerous cuts to quality of care for the elderly residents. Rationing of basic supplies such as bandages and sanitary undergarments, regardless of the actual needs of residents. Rationing of food, often to the point that residents suffered from moderate to severe malnutrition. As you can probably imagine, the onset of COVID did not improve the conditions at these facilities. Alleged financial irregularities included various forms of fraud. There are allegations of the forging of thousands of employment records to obtain larger government subsidies while facilities were, in reality, critically understaffed. A scheme known as retro-commissioning was used when purchasing government-funded supplies such as wheelchairs, medical supplies, and incontinence products, where large order sizes were used to negotiate significant rebates, but subsidies were obtained based on the initial price, allowing the company to simply pocket the rebates. However, this led to a decline in the quality of the products being procured because they had to be manufactured for less money. While this was happening, senior management was allegedly embezzling money from the company through a variety of complex schemes. In the intervening years, this has led to investigations for breach of trust, fraud, aggravated misuse of corporate assets, organized money laundering, and private corruption. These investigations later led to police raids in France, Belgium, Luxembourg, Switzerland, Italy, and Portugal. After Castanet's book was released, it became an explosive controversy in France. The company's share price plummeted, investigations were initiated, as well as class action lawsuits. As a reminder, while all of this abuse, negligence, and fraud was allegedly taking place, CPP Investments had employees sitting on the board of directors. There's nothing to suggest that these board members were complicit in any of these activities, but one of the purported benefits of these large corporate buyouts is that you can sit on the board of directors and improve the governance of the company. If all of this could happen without being noticed by 2 directors, it makes me question the actual value of that process. Eventually, due to their heavy debt loads and falling share price, the company collapsed and had to be bailed out and recapitalized by France's sovereign wealth fund to prevent the care facilities from failing entirely. In March of 2023, as the company's ownership was undergoing restructuring, CPP Investments decided to divest from the company at a significant loss. This was announced on the CPP Investments website in a brief press release where they mentioned the dates the investment was acquired and sold, along with the amounts paid and received. Looking at the numbers in this release, along with the dividends received from approximately 9 years of ownership and the exchange rate in March of 2023, we lost approximately $500 million on this deal. Now, that amount of money doesn't actually do anything to destabilize the fund because it's a very large fund and that's a fraction of a percent of the total. But it seems like a lot of things went wrong, and $500 million is still a lot of money. And this wasn't even on the news. If you're watching this video, the overwhelming odds are that this is the first time you're hearing anything about any of this. I would even bet that most people who work for CPP Investments have not heard about it. There needs to be some sort of scrutiny. We spend days arguing with each other when a politician spends too much on airplane food or on moving expenses or about how much Mark Carney's shoes cost. But when a pension fund manager gets us heavily involved in a company that's apparently abusing vulnerable elderly people who are retirees themselves, while senior managers embezzle huge amounts of money, then the company implodes and we lose $500 million, we don't even hear about it. They post a note on the website, nobody notices or cares, then we move on and it gets lost in the sands of time. I really think this goes beyond a simple matter of some investments turn out good and some turn out bad. Apart from the questionable ethics of investing into a for-profit long-term care facility company, I can't see how this investment genuinely addressed any of the fund's liability management concerns. And it's not just this example, In the video, I briefly mentioned a Brazilian water services company called Saneamento. This was a public water utility in Brazil that was auctioned off to the private sector by former President Bolsonaro, and a few hours before the auction, the Rio de Janeiro state legislature voted to stop it. But Bolsonaro's interim governor just overruled the vote by decree, and they went ahead with the auction, and we still decided to participate in it, along with AIMCO, which is Alberta's pension fund manager. Along with that, other Canadian pension funds have bought up huge amounts of farmland in Brazil. And it's easy to say, well, it's fine because we're managing those assets in a socially responsible way. But ultimately, we're still buying up these critical, life-sustaining resources and extracting a profit from them. Personally, I think the people of Brazil have some sort of right to self-determination. But that right gets eroded when their food and their water are controlled by a bunch of foreign fund managers. On top of that, it's not even exactly clear whether or not these kinds of activities are providing value to the fund beneficiaries. But it's very clear that there's value being created for the finance industry. There's more than that. There's more that I left out than I left in. But I'm not here to make you hate CPP Investments. I just want to open the door to a public discussion. We can absolutely have some elements of active management in the strategy to address specific long-term liability requirements. But we need to think about what investment strategies are appropriate and which ones are inappropriate. We need to decide what we need to be involved in and what we don't need to be involved in. It can't just be a free-for-all. I think there's a specific discussion to be had here around our pension funds, but I also think there's a broader discussion that needs to be had about the increasing role of financialization in our economy, in our public institutions, and in our society. The increasing share of profits in the economy being made through the financial industry is one of the major driving factors in increasing wealth inequality, both here in Canada and internationally. And rising inequality is, in a lot of ways, the key driver of a lot of the problems that we're having now. So, thanks for watching. I sincerely apologize for taking this information from my brain and putting it in your brain, but I'll see you next time.